That is where the negotiation comes in. And to the extent that delta gets bigger and bigger between an asset sale and a stock sale, there's absolute opportunity to negotiate, to run a model to show the amount of additional tax that would be paid on an asset sale versus a stock sale. And depending on that delta compared to the benefit the buyer gets for that 15-year amortization, you'll find the middle ground somewhere.
Why do asset versus stock sales matter so much from a tax standpoint? Which one usually results in more after-tax cash? Why do buyers often push for asset sales? And where do FREORGs fit into all of this? To answer these questions and others, I am delighted to welcome, again, Dave Wanis, tax principal at Weaver, to our show. Tax is a big topic, and there is a lot to cover. So we chose to break this down into a number of episodes. This is the second, and it focuses on tax considerations when choosing between asset sales and stock sales. Listen in. But first, let's get some housekeeping out of the way. My name is Madhur Dugar. I am a senior M&A advisor at Excendio Advisors, focused around MSPs and IT services. And this is my podcast series, M&A Insights. If you are interested in finding out more about how we are helping MSPs exit or grow inorganically, write to me at madhur@excendio.com, connect with me over LinkedIn, or visit our website, www.excendio.com. Let's get started. Dave, welcome to our second episode on this tax sequence. Today's topic for listeners is exit tax structuring to maximize value and focusing on asset versus stock sales. Big topic of conversation. So just like with the last one, let's get straight to it. At a high level, what's the difference between an asset sale and a stock sale? And why does it matter so much from a tax standpoint?
Yeah, it's a good question. There, primarily from a seller's perspective, there are two main differences between an asset sale and a stock sale. The first is who gets taxed, and the question is it the shareholder or owner themselves, or is it the entity, or is it both? And there can be cases where both will get taxed. And the second key area of it is normally there likely will be a difference in characterization of any gain that is generated on this sale. Capital gain rates are currently at 20% for federal. Ordinary income tax rates are at up to 37% for federal. And the key is a stock sale versus an asset sale might split the gain recognized into either capital or ordinary rather than just one or the other. In a stock sale, generally, all of the gain will be capital gain tax. Mm-hmm. In an asset sale, certain assets, just by definition and nature, mm-hmm. will be ordinary income assets, mm-hmm. and those can be taxed at either the entity's tax rate or, depending on how they're held, at the mm-hmm. individual's 37% tax rate.
Got it.
So it's always a calculation process to see what your actual tax will be after all is done.
Okay, and I know that the general rules are dangerous. Devil is always in the details. But can we think of something like an accounts receivable, for example, mm-hmm. as a candidate for an ordinary income tax treatment?
Sure. I that's a good example. I'll tell you, it gets a little bit technical just because mm-hmm. it kind of depends if they're on the accrual or cash method of accounting. I think a better example would be something like a fixed asset. So if I bought an asset for $100 mm-hmm. and I depreciated it, and so it's worth it. I took $100 deduction for it over the life of owning it. When I sell it back, or when I sell it to a buyer, any amount I get paid for that is going to be called recapture income and mm-hmm. taxed at ordinary rates because I took an ordinary deduction for it.
Got it. And so what this also implies is that there has to be an allocation of the purchase price to specific items on the balance sheet to then figure out, right, what the gain would be on that.
It's a great point. That is only typically in an asset sale for tax purposes because I have to allocate specifically to each of the assets. In a stock sale, since all I'm selling is one asset, the stock, I normally don't have to do it for tax purposes, although they may want it done for accounting purposes as well.
That's great. From the seller's point of view, what are typical tax consequences of the asset sale versus stock sale structure? And, again, from a rule of thumb perspective, and rule of thumbs are dangerous, but we like them, what can result in more after-tax cash in hand?
Yeah, and it's a great point. Obviously, as you mentioned, this always depends on your facts, right? We need to understand the facts. As a general matter, just because of these rate characterization differences, normally a stock sale will lead to less tax ultimately because it's taxed at capital gain rates and you know exactly the amount that you'll end up. Now, again, we'll talk about this in an upcoming podcast. There also might be benefits from the qualified small business stock position someone can take on it. On the other hand, an asset sale typically can end up with less, either because it recharacterizes the gain into ordinary, or because it gets taxed twice. So if I sold out of a corporation, it gets taxed at the corporate level. And then when I get the cash out to the owner, it gets taxed again. So that's the least efficient of all of them. Now, the other thing to consider is also what sort of compensation or consideration you're getting back for the deal. Cash is almost always taxable. There's really no way to sort of funge around that and not pay taxes on cash if it ends up in your pocket. If you're going to roll over or reinvest in the acquirer, there are certain strategies that can be taken so that exchange of your stock or asset for the buyer's stock or assets can be tax deferred. It'll get recognized when you ultimately dispose it, but not on day one.
Not on day one, right? But your basis in the stock that you get on day one is respected in that transfer to the new stock. Is that right?
Yes. Assuming you qualify for the tax-free treatment, whatever stock you held or whatever basis you held in either the stock or asset you're transferring will transfer over to the stock you get back in return.
Gotcha. So this is a strategy for tax deferral, and that might be preferable. It's a great point to keep in mind for listeners who prefer the cash route is this other piece of it, right?
Yeah, and a lot of time that plays two things. One is if you expect appreciation in your buyer and you expect to be able to monetize more than you would have if you've just taken cash today, that's one thing. And sometimes this also makes sense if you think tax rates will fall, because then you're deferring to a year in which you'll get a better benefit out of it.
Perfect. Yeah, great point as well. Let's talk about the buyer's perspective. So why do buyers, in our space push for asset sales? First of all, do you agree with that or not? But I feel like they do. And what tax advantages do they get in that structure compared to a stock sale?
Yeah. Yes, you're absolutely right. Buyers always like the asset sale first and foremost, if they can get to it. And we'll talk about that a bit. But because they are buying assets, and let's just presume it's all for cash or taxable compensation, they get what's called a step up in basis for whatever they purchase. So if I bought an asset for $100, again, I can depreciate that. And under the current OBBBA rules, if it's a fixed asset, so like a computer or a chair, I can immediately deduct that amount against my taxable income. And then there's a whole pool of what the residual would be after I do my allocation among the assets that goes into what we call intangibles or goodwill. That typically is also amortizable, but over 15 years instead. But it is a deduction. So as you can see on the buyer side, I spend the money and I actually get to amortize or depreciate and take a direct tax offset for the amount I've allocated. If I buy stock, it all goes into the basis of the stock, which is not a depreciable asset. So no tax benefit from that one.
So this is interesting because let's say you bought a company for 100. Let's say you bought a company that was worth 80 and you bought it for 100. So you got $20 of goodwill in my very simple world. You're going to depreciate that over 15 years, right? And so that has a present value for you in terms of the tax shield that it generates. And that tax shield is going to depend upon the tax rate. It's going to depend upon the discount rate at which you're discounting back those cash flows. It's going to depend upon the length of period, which is 15 years here. It's going to depend on the total amount of goodwill, which in this case is $20. All of those pieces individually go in to determine how valuable that goodwill is as an asset for the buyer. next question that it raises for me is, does it create an opportunity for negotiation between the buyer and the seller because the buyer is now getting this great advantage?
Absolutely, absolutely. And certain structures are going to lend themselves to these negotiations more than others. We talked a little bit about the C corporation and it being generally very inefficient to do an asset sale, and it typically would be. So that's one you typically won't see this happen with. By the same token, things like a partnership or a flow through will typically, just by nature of the structure, be treated as an asset sale for tax purposes. So you kind of default into that side. Really, where the magic of this comes in is the S corporation, because I can either treat it as a stock sale and take all that capital gain, or an asset sale and have multiple levels of and characterizations of gain. That is where the negotiation comes in. And to the extent that delta gets bigger and bigger between an asset sale and a stock sale, there's absolute opportunity to negotiate, to run a model. And typically the buyer will ask the seller to run the initial model that they can review to show the amount of additional tax that would be paid on an asset sale versus a stock sale. And depending on that delta compared to the benefit the buyer gets for that 15-year amortization, you'll find the middle ground somewhere. And you're absolutely right. Your inputs are tax rates, they are interest rates, and then the life of it is 15 years. So as long as you have those three things against the amount, you can figure out a middle ground to get a step up in the purchase price.
This calculation, I mean, yeah, I could put it together in an Excel spreadsheet and get an idea. Who typically does it for the seller? Does the seller do it himself, or he asks someone to do it for him?
I would tell you 99% of the time. Now, always depends on the seller, but 99% of the time, the seller is running the business. They're not the tax folks. So they ask whoever's preparing their tax returns or whoever representing them in the deal to help them run these calculations, because there are a lot of other nuances. It's not just,
of course,
ordinary versus capital gain. It could be state taxes that have an implication. There are other things that can all feed into what that real differential should be.
Yeah, I mean, if this is not completely obvious, I just want to state this. The purposes of these podcasts is not to walk away as tax experts, but it's to just get a general sprinkling of the kinds of issues that are involved, have a general understanding, but know that at the end of the day, there's enough detail that needs to get sorted out here that you really do want to get the advice of someone who's professional and does it on a regular basis.
Absolutely.
All this being said, there are hybrid structures in the marketplace. I'm thinking 338H10 elections that create the opportunity, if you will, to bake your cake and have it too. Is that right? And how does that work?
Yep, that's absolutely right. Again, there's no one size fits all to how we approach a particular deal. It always depends on your facts. The 338H10 is probably something someone has heard, and it's a complicated provision, but I'll tell you, it typically applies to either a subsidiary in a consolidated group, so I need a C corporate group, or an S corp. And that's a strategy to convert what otherwise would be a stock sale, which is exactly what they want from a legal perspective because it's clean and simple and easy, into a tax sale for tax purposes. And again, we talk about all the benefits you can get out of that, of a step up to the buyer and a potential higher consideration to the seller. There's, again, this qualified small business stock. I feel like we've touted it enough that people are going to be very excited for when we actually go into it in depth. And then plenty of other elections, F-reorgs, way to structure things so that we can get to the right tax answer for you based on the facts you have.
Right. Do you want to get a little bit into what an F-reorg structure looks like, even conceptually, like what happens there?
Sure. And the F-reorg is really something that's just come into play a lot more recently to take the place of the 338H10 because it's simpler and cleaner, and it does allow for being more creative in the structure of the transaction. In other words, it's easier to accommodate things like rollover, and you don't have to worry about certain ownership percentages and other things like that. But the essential concept of an F-reorg is that you just reorganize your company all very clean and easy from a tax perspective, and it's tried and true strategy. But you reorganize the structure so that you can just make a simple sale of a single entity over to a buyer, but it's treated like an asset purchase.
What steps can owners take years before sale, right? Such as entity choice, F-reorg elections, et cetera, to maximize the flexibility and minimize taxes when the exits finally come? And what behaviors do you even see in the marketplace?
As you're setting up, make sure you're talking to someone early to assess the different strategies. Again, for an example, we talked about the C corporation sale typically causing less tax on a transaction. But the question is, if early in the life of the company you're generating losses, you may want to utilize those losses on your personal return, and you can't do that in a C corporation. Once you have an indication of when you're going to get into a transaction and sell the business, start the discussions of how to make any tweaks then, even if it's 5 years down the line.
Dave, thank you so much for the second episode of our podcast series around taxes. Really appreciate your time and look forward to doing the next one soon.
Thanks very much.